needle on the record.
Welcome to Wage Cucking with JMO.
All right, guys. Welcome to yet another episode of Wage Cucking with JMO. Due to the popularity of the last episode where I answered some Twitter questions, I decided to do another one of these. I'll probably try doing one of these like once every few weeks if we don't have guests or if there isn't anything interesting to talk about. But we have some guests lined up in the next few weeks, so this will be the last one for a little bit. So let's get started. Let me pull up the questions. All right, first question is from Martin J. Martin J.E. on Twitter. In the long run, where is Bitcoin miners' revenue coming from? What Bitcoin innovations are you looking forward to? Do you think there will be a usable Bitcoin layer 2 in the foreseeable future? All great questions. So the first one is, in the long run, where do Bitcoin miners' revenue is coming from? I think the simple answer is that the price of Bitcoin will go up. So in the future, like at any time there's a block halving, I think, at least in my eyes, it's safe to assume that the price of Bitcoin will be a bit higher. So like the block reward in USD might be around the same or if not greater. I mean, historically speaking, that's essentially what happened, although it's obviously not guaranteed in the future. But yeah, I think there's been a lot of discussion on like Bitcoin security budget, how we're going to secure the chain once like the blocks have and the reward goes down and down. I also think that interesting use cases for the Bitcoin blockchain, what we've seen recently with the whole ordinals movement, even though like a lot of the Bitcoin OGs will classify that as spams, basically, I feel like there's going to be more direct use cases of the Bitcoin network besides just like transacting Bitcoin back and forth and people holding it as a store of value. And that in theory generates fees for the Bitcoin network, which will therefore go back to the miners and keep the Bitcoin chain secure. Second part of the question is, what Bitcoin innovations are you looking forward to? I talked about this a little bit before, but Bit 300, Paul Storik's drive chain project. It's been like proposed for years and years, I believe. I wish I had Andreas here to talk about it a bit more because I'm sure he has a lot more to say about it. He also had, I believe he had an episode of just him doing a quick podcast with Paul talking about drive chains. But I think that will be out like within this year or maybe like early next year. So yeah, I'm definitely looking forward to that. Third part of the question, do you think there will be a usable Bitcoin layer 2 in the foreseeable future? I guess it depends on what you mean is usable. I mean, Bitcoin, although they're not really a layer 2, it's like if you talk to Bitcoin people, that they'll tell you that like it's not exactly a layer 2. But so stuff like OmniLayer has been around for some time. So stuff like Rootstock, Blockstream's Liquid network, Lightning, although those really haven't gained much adoption. But I do think in the future, like stuff like Rootstocks, stuff like Stacks, will develop like a quasi layer 2 ecosystem where they're going to have smart contracts on chain, and you can do a decent amount of the stuff that you can do on something like Ethereum on Bitcoin in the future. I honestly don't really know. It depends on what you classify as usable. Is it going to be competitive with like the alternate layer ones that are popping up that have like awesome new technology, like super high throughput, can facilitate a bunch of use cases? Probably not. But they will exist, and the level of adoption that they get, I guess, will vary. I'm not exactly sure. All right, next question. Jordan Kaplan, Twitter Kaplan_Jordan. Current opinion on Kyle Samani and Multicoin. Their rep on crypto Twitter has seen some big swings over the years. Yeah, I don't really know too much about them outside of their online presence. I generally have a uh, more bearish bias towards like these bigger funds, just because the way that they're designed. Like, so for example, if you, I don't know if this is specific to Multicoin or not, but let's say you invest in like a fund similar to Multicoin. In general, they have a model that is from traditional finance, where they take something like 2 and 20, so like a 20% performance fee and like a 2% management fee, which makes sense in traditional finance because like the yearly swings aren't that high. So what that means is like in traditional finance, your fund can go up like 20% one year, down 10% another year, so on and so forth. But in the crypto market, like in general, basically every single fund does well during bull markets. They go up like 5, 6, 700%. And then like during bear markets, they lose like 70, 80, 90%. And that's true for like, I think even the best of funds are the most reputable funds. Yeah. So the problem with this model is they're taking the performance fee on like the high water mark. So basically at the end of the bull market, they'll take like 20% of their performance when they're up 700%, and that's their high water mark. So let's say you deposit $100,000 into a fund, it goes up to $700,000. They take their 20%. The high water mark for your position is $100,000. If it goes down, let's say even 50% to $350,000, they need to essentially double their fund before they see another performance fee. So then they get into situations where, like the incentives aren't aligned. They're definitely incentivized to gamble a lot more with your money, rather than take on safe investments if they're in this position, because they know they're not going to see another performance fee until they get to that high water mark. So their goal is to get back to that high water mark as quickly as possible, and that isn't really necessarily great for you. It could be if it goes well, but it could be really bad if it doesn't. With regard to Multicoin specifically, I know they. I guess I only know them through like their investments in like the Solana ecosystem type stuff. So I think they invested in stuff like Jido, Drift, MarginFi, which all are great protocols that I'm pretty bullish on. But they also had like a pretty big vested, I believe, Project Serum position, which like this is like in their FTX days. They were like pretty close to FTX. I think their fund was down 90% in 2021 or 2022, or I forget which year. But it was mainly because like they had all these positions through FTX, and they had like a huge balance on FTX. Their positions through Solana ecosystem stuff was through FTX, so they took like a pretty big loss. Other than that, um, I think Kyle's said like some like pretty dumb stuff on Twitter. Like the one thing I can remember that's like become a meme at this point was he was talking about like Solana versus Ethereum, and basically he said he prefers the Solana chain because it's faster, and he puts higher priority in speed rather than like security of chain, which is not how you should respond to that question. I mean, like if you're bullish on Solana, you think that Solana is a secure chain to transact on, not necessarily like you're sacrificing these massive security features in order to have like an upgrade in speed. But yeah, that logic to me doesn't make much sense. Other than that, I can't really think of anything he's said. So I don't really have a great opinion on him, or like I can't really create like a well-rounded opinion on him without knowing more about him and his fund. Next question. Riaz A at Riaz with 3 Z's. Best DeFi yield farming strategy for long-term BTC and ETH holders. BTC, I'm not so sure that there isn't much you can do on BTC on chain. I don't think. I think your best bet is using it as collateral and using it to borrow other assets to do DeFi farming with. So I think the best thing you could do is like convert it to wrap Bitcoin or a similar type of like on-chain Bitcoin, like Avalanche's BTCB, and then using that as collateral and borrowing like say stables or Ethereum or stuff like that to run strats with. Ethereum, right now, I'd say if you're a long-term holder in Ethereum, you get into some sort of Ethereum staking, whether it's like self-staking or going through an LST. There's a lot of like good options out there. You have like Lido, you have a Rocket Pool, you have like all these eigenlayer or restaking protocols. You have a Mantle Ethereum, which I think is like, at least for the next few months, like doubling the yield of staked ETH and paying it out to their treasury. So yeah, I would probably have a diverse bag of these and then figure out which ones to make the most sense, and but possibly get into some restaking, possibly use other protocols. You can also do stuff like, um, for example, if you deposit your Ethereum into something like Lido, they have a wrap version of their token, so you can wrap your Lido, put it in like a protocol where you can use that as collateral, borrow other assets against that Ethereum. So not only are you using your Ethereum for collateral, but your collateral is accumulating yield through staking. And that's a pretty capital efficient way to handle your DeFi positions. Next question. Extremely solvent. Twitter name insolvent. Thoughts on BNB? Binance gives out more airdrops than anywhere else through Launchpool, yet BNB is performing poorly versus the market despite airdrop farming initiative. Yeah, I think the market is like correct on this one. Binance as a whole is, I think, losing market share ever since CZ stepped down. They're still by far the biggest exchange, but I think they went from somewhere like after the FTX collapse, they're somewhere around like, I want to say like 70 to 80%. Maybe not that high, but like maybe around 70% market dominance, and then I think they're like at or below 50% right now. So if you think the BNB token is an accurate projection on like the valuation of Binance relative to the rest of the crypto, I do think that they're losing market share. I don't think it's a good reason that like the use case for holding BNB is to get access to their launch pool. I think the strategy, like a lot of people employ, is they maybe buy the BNB for the launch pool, or they'll just borrow the BNB and stake it for the launch pool, and then pay the funding rate for BNB. But in and of itself, just because like their launch pool is good and they require you to use BNB, doesn't necessarily add that much value to the token, especially when there's like a lot of markets where you can just like borrow these assets and hold them short term, just because like there aren't a ton of projects. Like there isn't like a launchpad project out every day, so it doesn't make sense for you to hold it only for that purpose for the course of like months or years. Whereas if there's like a week long period every month where that there's a launchpad staking opportunity, for most people, I feel like it's more capital efficient for them, especially if they're not bullish on the coin, but they want to see the returns in the launchpad, to borrow that asset, deposit it on Binance, and then return that asset after the launchpad is done. Other than that, I think this whole like airdrop launchpad thing, this whole like narrative where basically these coins are sort of being printed out of thin air, will eventually die down. I mean, like I've looked at the Binance data for launchpads. Like in general, their token does pretty good when they get listed on Binance. But then in general, that they follow sort of a similar pattern, with a few exceptions. There are a few like really good long term projects that have come out of Binance Launchpad. But a majority of them have like an initial pump where they go up like quite a bit, and then like a lot of people start selling, and then it's just like a slow a slow trend down for quite some time. So yeah, I'm not so sure about this model. Like, I don't know if this model will like last into the future where, let's say 2 years from now, like, is it always going to be profitable to hold BNB in their launch pad and stake it and have allocation to these new projects that will be listing on Binance? I'm not so sure. All right, next question. Oh, and one thing I wanted to add to the Binance thing, I think that we're going to have a push towards like actual decentralization. So my thesis is that like the on-chain products, but whether it's like perpetuals or spot markets or futures or whatever, like Binance offers in their trading suite, I feel like those are going to improve greatly on chain to a point where a lot of their volume might go to like a decentralized exchange and stuff like that. So I think in the future there's going to be less of an emphasis on the the value of centralized exchanges, where like a lot of the stuff that you can do right now on a centralized exchange that you can't do on a decentralized exchange. So that like bridge will be gapped pretty quickly to a point where I think like this is not specific to Binance, but it's to all centralized exchanges. But I think they all constantly will start bleeding market share to the new decentralized exchanges that are coming out right now. Next question. Professor Samovar, Prof. Samovar. Two-part question. What do you think about Hyperliquid? What is your favorite perp? Oh, this is a lot of questions, actually. What do you think about Hyperliquid? What is your favorite perp DEXes? What are your favorite perp DEXes and which can bypass DYDX? What perp DEXes use to get what can perp DEXes use to get closer to volume to centralized exchanges? And then the second part of the question is what's missing in DeFi? It seems like big innovation ended a few years ago, and now it's the small product changes stage. Yeah, I would agree with that. So first question, what do you think of Hyperliquid X? It's called Hyperliquid X, right? It's a perp exchange on Arbitrum. I'd say I like it a lot, actually. It's similar to like the other perp exchanges that crowdsource liquidity as market makers. So on Arbitrum, I'd say it's like its closest comparison is something like GMX. However, the GMX GLP pool, I feel like is a little bit less sophisticated than the Hyperliquid one. So the GMX pool just has like target ratios for certain assets, and then like that pool is essentially the liquidity pool that the traders counter trade against. Hyperliquid X, I believe it's called what is it called? HLP. I haven't looked into it too much, but they have some like, I believe it's like an algorithmic like market making strategy. I don't know exactly how it works, but like I've only looked at its past performance, and in general, it performs like quite well. So yeah, I think it's doing good. I've traded a little bit on it. One cool thing they do is they're really on top of the demand for these markets. So I think they offer somewhere around like 100 or like 150 assets. I'm not exactly sure. But anytime there's like a hot coin or there's something that people want to be traded, they'll list it so you can trade perpetuals of it. Yes, so I'm pretty bullish on that project. Second part, what are your favorite perp DEXs and which can bypass DYDX? I'm not sure if any will bypass DYDX. I like, we talk about Hyperliquid. I like GMX. I like GNS Gains Network. I like Quenta. They also offer like a large list of assets to trade. I think that's my one issue with GMX is like they don't offer that many assets. And it's mainly Bitcoin, Ethereum stable coins, and then like depending on if you're trading on AVAX or if you're trading on Arbitrum, it's like native AVAX. I think they have like Link in there. They have a few other things. What else? I think they have like Solana in there as well on the AVAX pool, but it's mostly just like pretty high market cap stuff, which makes sense given how their GLP and then their GM pools are designed. But I'm not sure if any one of those can bypass DYDX, because DYDX sort of offers like a unique experience that it draws like the high volume traders, just because like it's basically plugged into a central limit order book. So if you're like a high volume like institutional trader, maybe you don't want to deal with like bridging to Arbitrum, dealing with like the chain latency, stuff like that. Where the trading experience, at least for like the higher level traders, I think on DYDX is a bit more sophisticated. They also have like a slew of the very large market makers that are that's definitely helping out those markets be like more efficient and operate better. Where like the model for like this crowd-funded market making liquidity type thing that like GMX and Hyperliquid is focusing on, I'm not sure if that lasts, because it relies on people to put their assets into a pool, which is essentially counter traded by like all traders on the platform. So if the traders on the platform get a bit too sophisticated and are like winning too much, it's at a cost of like the LP providers. The LP providers will then realize they're losing a lot of money and pull their liquidity, and then they're sort of back to square one, where they can't really bootstrap liquidity because there's too many like sharp traders on the chain or on their protocol that are causing issues for LP providers. The final part of the question is, what can perp DEXes use to get closer to volume to centralized exchanges? I don't think it's a thing that like perp DEXes can really do. I think it's more of that the chain that they're on being able to facilitate what they're trying to do. Basically having like high speed, high throughput, no downtime, low fees on the chain, stuff like that. And then also I'd say just like the process of like getting assets to where they need to be in a secure way. So for example, if I'm like an institutional trader, or if I like operate a big fund, I'm pretty happy with my setup on like a centralized exchange where I probably have a VIP manager that I can contact anytime there's a problem. But if I start trading on like a DEX on let's say like a Cosmos chain or something, I would need to figure out how to get my assets off the centralized exchange to this chain, have a secure setup, and then to a point where there isn't like someone you can call if something goes wrong. You're sort of at like the mercy of the DEX and the chain itself. But I think like these issues are being solved. Like I think in the future, the framework for these exchanges and these chains will be more solid and will facilitate traders and transactions a lot better. So naturally, I think people also would prefer a fully decentralized experience. I mean, if you look at especially in times of volatility, like if you compare like the funding rates or the fees on decentralized exchanges versus centralized exchanges, I think a lot of the times the decentralized exchanges are order of magnitudes higher, but they still get like quite a bit of volume, just because it appears like the market is saying that there's demand for like fully decentralized exchange alternatives, even if like the fee structure of them isn't competitive with centralized exchanges. People would rather pay more to have a fully decentralized experience. So like I think there's definitely demand there. And I think it's just like a technological thing, an ease of use thing that will allow DEXs to bridge the gap. Next part of the question. What is missing in DeFi? It seems like big innovation ended a few years ago, and there are now small product change stage. Yeah, that's a good question. Like, I think if I could answer this, I'd be like a billionaire because I'd solve like the issue of decentralized finance. I'm not sure exactly what's missing, but I do think that like you're right. It feels like a lot of the protocols that are coming out are sort of just like copy paste or like clones of previous protocols with like one small tweak. You make like a change to this protocol, and then you get this new protocol, and then they raise funds, they have a token and stuff like that. Um, there haven't been that many like really good basically 0 to 1s in DeFi, basically paradigm changing protocols. And it's one of the things that like interests me the most. Like one of the protocols I had on the podcast recently was Athena. I thought that idea was fantastic. Basically, they create a synthetic stablecoin where they deposit half your Ethereum on Beacon Chain staking, and they open up a 1x short on a perpetual contract. So they create a market neutral position, but in general, they get paid on both sides of that position. So it's like a yield bearing stablecoin because they get paid for staking, and they generally get paid funding rates for shorting the perpetual, especially like in times in the market cycle where everyone is bullish and the funding rate is very favorable to the people that are short. I think stuff like that where that hasn't really been tried before or offers like a something interesting to the end user. But off the top of my head, I can't really like point to like this or this or this that needs to be developed. The stuff I talked about before is I think a big thing missing that can be solved is a solution to bridging, just because like now there are so many chains, so many layer ones that are popping up. It's pretty important, or I think if we want to exist in a like a multi-chain future, it's pretty important to be able to bridge seamlessly from chain to chain securely, using like a set protocol or a set way to do it, rather than like digging through, let's say, all these third party bridges and figuring out which one's safe, which one's not. Um, yeah, I know like my friends at Layer Zero are working on that right now. There's other companies that are working on that, but yeah, I just think transferring funds from chain to chain, or maybe using funds as collateral on one chain while borrowing on another chain, so you don't even have to do the bridging process. Stuff like that will make the whole decentralized finance experience a lot more seamless and a lot more easy to use for the end user, which is like bullish overall. It's a good question though. All right, next question. DeFi Donk at DeFi Donk. Can you discuss what metrics, attributes, or values you look for in considering an investment of a layer one? Or is it less metrics and more feel? I've heard you say something original or unique in previous podcasts, but I haven't heard much more than that in detail. Um, so now I think the first thing I look for is the number of users and how much of it is organic growth. I think the organic growth part is important. Just because like now it feels like all these new chains have like some points program, some airdrop program that that incentivize not only like people to use the chain, but for people to use this chain with many addresses, that may overinflate those numbers. Um, so if you just look at like users and growth numbers, you have to take it with a grain of salt, because are those users actually there because like the decentralized applications and like the chain is a good experience, or are they there with like 1,000 wallets each just because they think they're getting an airdrop? If it's the latter, it's not that bullish on the chain, just because like once the airdrop happens, it'll just be sell pressure on their token, and they'll probably move their funds or move their assets elsewhere to go to a different chain. The other thing that I look for is like the overall team and technology, what they're trying to build, how they're executing. What is the barrier to entry to get in on these chains? Like, how is the infrastructure so far? Do they have a nice wallet? Do they have a nice native bridge? What kind of decentralized applications are being built on these chains? Are they with good teams? Do they have like a lot of users? Are they are the user numbers like trending upwards? As in, like, is there more TVL? Is there more volume? Even TVL, I don't think is like a great metric, because again, like if people are just TVLing for airdrop farming, and the TVL isn't necessarily super efficient for decentralized finance, it's not a great metric. Other than that, yeah, I guess it's like a lot based on like narrative or feel, just because like I would say like a lot of these L1 investments aren't necessarily how to describe this, like you can't really point to a reason why like a token goes up. I guess it's a lot of them, or a lot of people would say, well, the more people that use any chain, the higher the fees are, the more fees go to the native token, and that's like only somewhat true, just because like a lot of these chains, if you look at their like their revenue through fees, and you look at their market cap, that there's no real correlation. Like a lot of them like are going to be overvalued by like huge factors compared to like the fees they're generating. So there isn't like a single metric that you can really look at here. I would say the overall sentiment, the overall like the number of users, the number of people talking about it, the number of people interested in what the chain is doing, what the apps on the chain are doing, and stuff like that. I think you can gauge all that and have like a rough guess as to if this chain's going to make it, or if this chain is undervalued or anything. Next question. Let's skip that one. But by the way, it's annoying when people just ask like, "What bag should I buy?" That adds basically no value to the conversation. Yeah, so I'm going to start ignoring those questions. I mean, yeah, I can tell you what bags I'm bullish on, but like if you listen to these, you can probably figure it out yourself. But the point of these is to have like interesting conceptual discussions, not for you to like 100 IQ figure out how to make money in crypto by just like copy trading someone. All right, next question. Ormika at Akimro is his Twitter name. You're long enough here to know the Chiliz Fan Token endeavor. Could you give your opinion on that kind of use cases for crypto? I think you have personal animosities with Alex. Maybe you can hide it and focus on the sense of connecting crypto with the sports world. Yeah, like I don't particularly believe in Alex, but that doesn't really that's not really a reflection of the project. I also don't particularly believe in the project. Um, I'll preface this by saying I don't know that much about it, but from my understanding is, I mean, basically they have partnerships with like a lot of the major sports teams, and then they issue a fan token for the sports teams, and the token is traded and has value, but it's the value is only the market value of the token when people are trading it back and forth. And then I think you can do like interesting stuff with the fan token. So, for example, if your favorite sports team has like if you own the token for your favorite sports teams, you can maybe like vote on what color their uniforms are, or like I think basically it's limited to stuff like that. It may work, it may not. I just don't see the long term value in something like this. I'm more interested in, like, it would be interesting to me for connecting crypto with like the real world sports, if like this is like a sort of a far fetched example, but like in the past there was something called Constitution DAO. Basically, people pooled that money together, like some like $40 or $50 million, in order to buy like a copy of the Constitution. I'd be more interested in something like that for a sports thing, where like there was some sort of DAO figured out that's funded in a way where it actually owns like the equity in the sports team, and like can delegate leaders and stuff like that. I'd say it's more applicable to stuff like esports. I think that'd be very interesting. But yeah, the whole Chiliz concept, unless I'm understanding it incorrectly, doesn't really interest me. Essentially, each that they're issuing like a native token for each team, and the fan tokens use case is like fairly limited. Basically, you can vote on like, or you can use it for the various things within the organization, but it doesn't necessarily like change the whole dynamics. You don't own equity. The if the team does well, your token doesn't necessarily go up. If the team does poorly, the token doesn't necessarily go down. I would also be interested in more gambling related stuff, because I think like the sports world and the gambling world are basically tied hand in hand. Where if a majority of people, well, maybe not a majority of people, but a lot of people that watch sports regularly, they like to gamble on sports. So I'd be more interested in stuff like that than just like a simple fan token, which is I think the only thing Chiliz is really doing. Although again, I don't know that much about the project itself. Next question, Jay Nanda's Poker, opinion on Pendle. I like Pendle a lot. I think it's an awesome protocol. It's like very unique. Essentially, you're allowed to trade future yield within the platform of like various tokens that they have on the platform, and I think it creates an interesting market. The thing I like about Pendle, I think, is that in the background it's like very complicated. Like even for me, understanding exactly what you're buying and selling, like the future yields, what these tokens are, is fairly difficult. But the user interface is designed well enough where I think even like your newer crypto users that are like getting into crypto, that are getting this into stuff like eigenlayer restaking, like LSTs and stuff like that, can understand how the markets work and like what you're buying and selling. So I think it's good in a way, especially if you have like a conceptually difficult protocol to understand. Having the user interface and the user experience be as seamless as possible is really good. I know their TVL is going up like crazy now, and I think it's mostly driven by this new restaking, locking your Ethereum or whatever tokens in for yield. It creates an interesting dynamic, and it creates an organic need for these markets. Just because there are downsides to stuff like eigenlayer restaking. Like the upside is your stake ETH gets yield, but then you also get like eigen points, or you get a future airdrop, or maybe you get an airdrop on top of an airdrop. The downside is you lose liquidity. Like, so for example, if you deposit all your assets into one basket and then suddenly there's something else you need your assets for, in general, the contracts that you're depositing your assets in initially, you can't withdraw them in any way. But something like Pendle offers liquidity for those people who, well, let's say that they have a position that's like locked for 3 months that they know is going to yield like 10%. If they need liquidity now, something like Pendle can create a market on that, where people can buy your position at a discount, capture that future yield, and then you have liquidity to use now. So yeah, it definitely solves a need in crypto, I think, and I think it will continue to get bigger. It's also one of those protocols that I don't think is like really a copy and paste of anything. Which a lot of the protocols I see pop up are like very similar to the ones before. Even something like I talked about earlier, like Hyperliquid. It's it's different in a way than a lot of the perp DEXes, but it isn't that much different where like the end user can differentiate that much between Hyperliquid and then something like Quenta, or so something like Drift on Solana. Whereas I don't think, I could be mistaken, but I don't think that there's anything remotely close to what Pendle is doing that has that much TVL and that much volume. I'll do one more question. Javier Wang, screen name at Dur. Do you think there's enough new money to sustain all these new chains and projects? Oh, that's a good question. I actually think about this constantly because like this whole airdrop, like new chains coming out, new protocols coming out, they're all releasing a token. You got to sort of question where the money is coming from. Like in theory, that they're essentially all just printing money out of thin air, but the money is backed by like their protocol or the value of their protocol. So the question is, are these protocols like actually that valuable, or are all these chains actually that valuable? Where like long term the price will hold because of the value of the chain, or is a certain portion of retail just like getting fleeced, which I think is fairly likely. So like there are people like farming airdrops. Their model is we deposit capital, we farm this token, we sell this token, and we like accumulate more Bitcoin, more Ethereum, more stable coins, more Solana, more whatever. And then there's like a group of people who are essentially exit liquidity for these people. Whether they're like winning or losing is questionable. I think some protocols that do airdrops, their token prices will rise over time. I think a majority will go down over time. So in general, like I think a lot of the money that's like going into crypto through these new chains and projects, it isn't really that sustainable. It's more of like still like the greater fool theory. Like we have a shiny new coin, there's going to be demand for it. There's going to be retail that's going to buy without understanding like the risks or the need or anything like that. And a lot of this, a lot of retail is going to get wrecked, being used as exit liquidity by either insiders or by farmers or by stuff like that. One thing I am bullish on is I talked about in this previous podcast, but stuff like Bitcoin ETF, Ethereum ETF, crypto being more accessible to the general population, especially the population that isn't technically sound, that isn't going to figure out how to like bridge assets to like Polkadot or Cosmos, or like figure out how to get assets on Ethereum and bridge to something like Blast or Manta. Um, I feel like in the future that gap will be closed slowly, but it will be closed to a point where there's always going to be new money within ecosystems. The question is how quickly the new money comes in, and then also how much of the ecosystem is depleted by like retail getting fleeced, like by this whole PvP scenario. I think we see in a lot of these chains with a lot of these airdrops and a lot of these new tokens, where if you're making money, it's more of a direct result of other people losing money on that chain doing the opposite of what you're doing, rather than like the chain or the protocol um, building value or generating value and the value going back to you. Um, yeah, so I think in the future, I think crypto is like always going to be PvP. There's no way around it. Like there's people that they're going to lose money in poker until or in crypto until the end of time. There's people that are going to make money in crypto until the end of time, and it's not exactly zero sum, because there's outside money. There's the value driven back to the users, value driven back to protocols and stuff like that. But the inherent like the inherent PvP style of like you're attempting to outtrade other people, that they're buying these bags, you're selling these bags. Like if one of you wins, the other one loses. That's, I feel like, is always going to be part of the whole cryptocurrency experience. Yeah. To answer your question, so the question was, do you think there's enough money to sustain all new chains and these projects? No, I don't think so. In fact, I think like a majority of them will fall off. I think we'll have maybe around like 5 or 6 like major L1s outside of Ethereum that like a majority of the volume users go to, and that's at maximum. I think we'll have like maybe like around the same amount of L2s on Ethereum. I think each chain will have like a predominant DEX, a predominant like perpetual protocol, a predominant borrow lend protocol, and like a lot of the smaller ones that are like either competing for a small share of a large market, or a large share of a smaller market, where they're focusing on a certain niche. I feel like a majority of those will die out. Yeah, it's tough to see like a world where there's enough money for like 30 different L1s to be like absolutely flourishing right now. And in the future, I think it's like pretty unlikely as well. All right. I think that's enough questions for today. I think the next few weeks we'll have some guests on, and I'm probably going on vacation next month. But maybe in like a month or a month and a half, I'll do another one of these Q&As if everyone enjoys them.